If you're wondering what are the best AI stocks to buy right now with the current valuations, then this is the video for you. Felix here, I'm going to share with you everything I learned as a former investment banker. I'm going to not just tell you which are the stocks I like, but I'll actually show you the data points so you can come to your own conclusions so you become smarter as an investor, which is what this is all about. Before we dive into this, I want you to do one thing for yourself, maybe even two things. One is join me for a live trading training because, well, we made 105% return on capital employed last year. We made 126% the year before. And so far this year, we are doing about $4,000 profit on about a $30,000 portfolio. And the very system that I use, I'm going to teach to you completely for free on Tuesday in a live trading session. We'll do some live trading together and everything else. Go to felixfriends.org/webinar and get your pause on it. Secondly, I've also prepared for you a benchmark, not just of the AI stocks we're looking at here, but of about 24 of the major AI stocks out there. And you can get your pause on that for free as well, felixfriends.org/AI. And you can filter by gross margin or return on invested capital or margins or PE and forward PE, long-term earnings growth, all the good stuff. And it'll help you to become a smarter, better informed investor, which is what I want for you. But let's get cracking with company number one. Some of these are big, some of these are less big. I think the last one is in many ways the most interesting. So stick around till the end because I want to also explain to you how the whole chip sector actually works. And I think that's really important to understand for someone interested in AI. So let's get cracking here with Bezos's Amazon. And cash flow is so-so, and that's largely because, A, they're reinvesting a lot, and also the retail business isn't really a great business yet. Stock's been going up a lot, price momentum. We actually don't like that. It means it's relatively expensive, but growth is pretty extraordinary, and it's very profitable. And it's not super expensive, and you're never going to get like an A or B or C really for a company that is this profitable and growing this quickly. A D is all right. You know, it could be an E or an F, right? And you get spanked, that kind of thing. Now, I think you know what Amazon does, but if you don't, well, I don't know who you are or where you live. You know what they do. I don't need to explain it. Gross profit margin, 47%. To me, I like companies with more than a 60% gross profit margin. Now, within this, there is retail, basically. The retail business has very, very low margins. And then there is stuff like AWS, which has super, super high margins. So it averages out. And therefore, actually, there is a really great business, actually a couple of really great businesses in this in terms of advertising and cloud and everything else. So it's a bit of an unusual one. Now it's a monster with almost $500 billion or more than $500 billion in revenue, 30 billion profit, 9% return on invested capital. Importantly, that is improving. And that's kind of what I'm going to talk about here. AI is helping them also to improve that. And it's growing their profits at 22% a year. My rule of thumb is take these two numbers together. And in my view, the stock will move 9 to 22% per year on average. Financial advice. You know, my cat told me that. She's sleeping behind me. She's cold. There she is, under a jumper. And so the numbers are pretty respectable, right? You look at financials, free cash flow, well, it's $32 billion. And that's a huge improvement from the last 2 years. And it just means that they can invest like heck, like they always have. And I was just reading an article from 2015 on Amazon, and the criticism was they're just spending money, they're building infrastructure and logistics, and this is a charity, this is just built to make consumers happy and shareholders poor and that kind of thing. And all of the logistics network that they have, what is it going to benefit from? AI. It's going to get easier, cheaper, more efficient. And where do you get all your computing power from? Well, a lot of it, AWS. So they benefit on both sides of the model. What about that $80 billion advertising business that they have, which is bigger than YouTube, seriously? Well, that's going to get better and more efficient in terms of targeting and matching viewers or shoppers with ads and so on. So I think they are benefiting on all fronts. And generally, I would say companies with very, very large workforces will benefit more from AI than leaner ones. And Amazon definitely is that. Then you've got the robotics front. They're developing their own, sort of Tesla robots and all of that. So they will be able to, sometime down the road, be able to run the vast majority of the logistics without people. You think that makes it cheaper? Heck yeah. You think that improves the margin? Heck yeah. You think that moves the stock price up? Well, I certainly think so. So that's why I like Amazon, and management has been pretty solid. The last year, we've had very significant earnings beats, revenue beats. There was a bit of a post-COVID wobble in a bit of the data, but we know we're out of the woods now with that. They basically just overbuilt capacity, thinking that the COVID time was going to last forever. It didn't. I know the billionaires are all crying in the basement. We could like COVID. We made more money then. And is it cheap? No, 41 times PE isn't cheap. But if they grow at just the analyst expected levels, including some negative years and growth really slowing, you still in 10 years get to a 14 times PE, which is reasonable, right? So I like it. I think they're going to grow faster than analysts expect. So I actually think the valuations are going to be even better than that. Second stock here, Salesforce. CRM is the ticker. Cash flow, brilliant. It's growing insanely. Price momentum, we don't actually like that, but profit health's out of this world. Same sort of price valuation range as Amazon, which is okay. And if you worked for any major organization, you've probably used CRM. They are just the leader in basically sales data, right? Customer relationship management. That's why they have the ticker CRM. And they're also in Slack, which we also use as well. I think, do they own Tableau as well? Did they buy that? Or is that still a separate business? I'm not sure. Anyway, gross profit margin at 75% is wonderful. Just wonderful. I want to kiss it. And net income, 4 billion out of 34 billion revenue is decent, and it's accelerating very nicely. Earnings at 22% is glorious. Return on invested capital could be better, but it is improving a lot. So once again, my rule of thumb would be 7 to 22% up on the stock. Not every year, not necessarily this year, but sort of in the long run, that's kind of my sticking your thumb in the wind approach to valuations. And let's just have a quick look at this. Free cash flow. 9.5 billion free cash flow on 34 billion revenue. That's about 30%. That's a sign of a very, very well-run business. Very good management manages to extract that much cash from the business. They're not going to dilute you. They don't have to issue bonds. They just got money coming out of their ears, buybacks. Let's hope they don't do any stupid mergers. And look at how often they beat market expectations on earnings per share and revenue. Every single freaking time for the last, 10 or 8 quarters. 8 quarters. Again, that's a sign of management being in control. Very, very good stuff. And is it expensive? Well, it's a little cheaper than Amazon. It's maybe a little less exciting than Amazon in some senses because the robotics and the chips and the cloud and everything else, CRM doesn't have that. They might even be a customer of Amazon. But again, with very almost single-digit growth there, we would get that PE from 31 to about 12. I think it's beatable. So I think, again, it's a very good business at a not insane valuation. That's the way I look at that. Now, there's another big one. We are going to get to some smaller ones in a moment as well. Microsoft, one of my beloved Microsoft favorites. Growth is glorious, cash flow so-so, but profit health is just extraordinary. I mean, it makes you want to weep, on a beach near you. And it's not super expensive, bizarrely. They kind of own the commercialization of AI, essentially, on a software level. They're the first ones out there who are actually making money out of OpenAI, LLMs, pitching it to you, charging it to you. Popped up on my desktop the other day, completely unprompted, Do you want to switch to Bing for search? Do you want to get the Bing Copilot? A lot of people will do that, and they'll pay the extra $19. And millions of people will do that, and it'll add billions of dollars of value to Microsoft. So it's just a brilliant business. Gross profit margin at basically 70% is fantastic. 80 billion revenue, profit rather, on 22 billion revenue. Extraordinary. Return on invested capital, 28%. That's extraordinary. And it's growing its profit. Insane. This company was founded when? 1980 something? Incredible to set up this growth rate. And so again, my rule of thumb, 17 to 28% share price increase. Not financial advice, but that's sort of my, kind of thing. And it's been doing something like that over the last few years. And I think the party's just getting started. Have a look at their free cash flow. $67 billion free cash flow. They don't know what to do with it. What can they do with it? Buy back shares. That's pretty much all they can do with it. So shareholders should like it. And yeah, again, glorious management, beating on pretty much every earnings count for the last 2 years. Very, very consistent, high quality management. And is it expensive? Well, 35x PE doesn't sound cheap. But once again, you got to look forward. I'm talking here about longer term investments, not making money by Friday, right? Come and learn to trade with me, and we'll talk about making money by Friday on our webinar. Links down below, felixruns.org/webinar. And even with this growth here, basically 10% a year, they would get to a 12x over time because your current P, your price is fixed and your earnings keep going up, and which will be reasonable, right? Wouldn't be bad. You'd make 8% shareholder yield. Could get way worse. Of course, we could not do this video without NVIDIA, who we're thanking for the NVIDIA broadcast app. This very software video is being recorded on. That's not a sponsored pitch, by the way. We don't do sponsored pitches. I don't really like endorsing things unless I use them and I like them, and I'd rather just tell you rather than, tell you go get some free shares for some dodgy broker somewhere. So that's not happening here. Cash flow's glorious. It's growing insanely. Profit health is out of this world. The only fly in the oyster is the price momentum. So is it expensive? Well, actually, bizarrely, it's not massively expensive. And we'll have to have a look at the why. And you know what they do, right? Well, GPUs, basically, which are graphics processing units. And a lot for cloud, a lot of the most cutting-edge AI stuff requires essentially NVIDIA GPUs. And they're also building out their own software, which means you have to use an NVIDIA GPU to be able to use their software. I love that. I think Microsoft's going to catch on to that. There'll be Microsoft-compatible chips, I think, coming. And you have to pay a license fee to them for it. Revenue, 60 billion. Half of that is profit. It's a 50% real net profit margin. That's just unheard of, especially within chips. And stick around to the last one. I'll really walk you through how the chip industry works, the semiconductor industry works. I think that's really important. And of course, gross profit margin is glorious for a sort of semi-manufacturer. Return on invested capital is, again, an insane number, and profit growth also. So our rule of thumb sounds weird to write down, 31 to 64% growth per year. Sounds really weird, but that's what the data is right now. So it's just baffling. And free cash flow is 27 billion on 60 billion revenue. So again, almost half the money they bring in is just free cash flow. They can pretty much outspend on R&D anybody. They can do whatever the frick they like. They can finance all the orders of all the small clients that they have and all that stuff, which is what they're doing partially, and grow and grow and grow. They can buy back shares if they want to, and they've just been on a absolute massive beats here, right? Just again and again and again. At some point, those beats will get a little bit smaller because you can't beat that much forever. But for the moment, let's enjoy the party. And is it really expensive? Well, it's a 35x. It's like CRM. Seriously. And with growth slowing down to allegedly 0 in 29 and then sort of 10% for the next 5 years, you get that to a 14x. It's not insanely overvalued. It's not. Does that mean you should chuck all your money at NVIDIA today? No, of course not. Like, if you like your stocks, ease into them gradually, put a certain amount of money into the stocks you like every single month till death do us part. And that's how you feel less upset when they drop 30%. NVIDIA will at some point drop 30%. Yes, it will. And then it'll probably go back up again at some point. But you gotta be able to live with the volatility, right? And here is a stock we never talk about. Palantir. What do they do? What do they make? coffee cups or something. Cash flow is extraordinary. It's growing at an extraordinary level. It's so profitable, but they've only just become profitable. And it's freaking expensive by this. Well, we have just had a massive rally. And let's go through this. What do? Well, software platforms, civilian and military, and AIP, which basically is an AI environment, open source, self-hosted, commercial large language models that can transform structured and unstructured data into stuff that you and I can possibly understand. And I put out another video yesterday walking you through that, showing you some real videos and everything else, so check that out. And it's in beautiful margins. Revenue is pretty small, and profit is only about 10%, but they're only just getting started with that. Return on invested capital is terrible, but earnings are growing quite nicely. So why is it so terrible? Because it's founder-led. And Alex Karp says, I don't care about profit. I'm not going to charge people for the best product we have, which is AIP. Because we just want to get that product installed everywhere. And then once they love it, once they run their businesses on it, we'll sit down and have that conversation. And people are not going to turn it off because they know it now runs their business. I like it. And only founder-led companies can do that, because otherwise you have to give in to Wall Street, who will say, you better charge them now because we want to see the numbers. So they're not going to do that. And I like it. But it means that the numbers are going to disappoint for some quarters, and it's going to look expensive. But they also bring in tremendous cash flow, $700 million. It'll be $1 billion this year on 2.2 revenue. So 30% plus free cash flow. They don't need anybody. They don't need money. They don't need to buy stuff. They don't need to merge. They don't need to issue bonds. They can undo the share-based compensation dilution by buying back their own shares, which is what they're doing. So I like it. They've been consistent, very consistent as management goes. And yeah, it's freaking expensive. Probably the most expensive stock we've got on our list here. 80 times PE. But even with Wall Street doubters, with the analysts thinking, no, this is never going to grow more than 15% or 20% a year, you still get to a 16x in 10 years, which isn't amazing, but it's also not really terrible. So again, I would have a longer term horizon on this. There will be dips, and maybe enjoy the dips if you like, skinny dipping. Here's another small cap, Tesla. And Tesla is in many ways the ultimate AI company. Cash flow is great, growing nicely, very profitable. Stocks come down. We love that. So it's relatively inexpensive. And there are three parts really to Tesla that I like. One is they are actually developing AI. Secondly, cars will use AI, so they'll be their own customer. And then you've got robotics, which again requires AI. So they're kind of just building out this own ecosystem. And I like that. I like companies that solve their own problems. So, making cars is a total freaking nightmare. And therefore, they're doing the robotics thing. Driving cars is a freaking nightmare. And therefore, AI will make it easier for cars to drive themselves. Sort of does already. And I like that. Like, the best businesses, the best ideas come out of solving problems that you have in your life and in your business. Is it very profitable? No, it's a freaking disaster in terms of margin. Why? It's a manufacturer. They manufacture cars. It's not a very sexy business. 20% gross profit margin is usually extraordinary. So they're doing relatively well on that. And it's profitable. Pretty decent margin. Return on invested capital is just about respectable. Earnings are very good. And if you look at their numbers, just under 100 billion in revenue, 4 billion free cash flow. Not a lot. 5%, 6%, but enough, probably. So why do I like it? Because it's reminds me a little bit of the Palantir model. Founder-led business, doesn't give a hoot about what happens this quarter or next quarter, just intent on building the most amazing product and service and thinking 5 years ahead, 10 years ahead, and not about the next quarter. And I like that. And the cheaper it gets from a stock price point of view, the more I like it. And yeah, earnings have not been good. And that could be a really interesting buy opportunity, right? big misses for the last 2 quarters. Not big, but significant misses. And that could make this an interesting entry point. Is it cheap? No, not really. 55 times PE at the moment. But Wall Street's expectations of it growing in the sort of high teens on average would get that to about a 9x, which is not too shabby. It's sort of a 11% shareholder yield or something like that. So, you wait long enough, it actually looks all right. Now, here is one. Taiwan semiconductor manufacturing. And I want to zoom to the right a little bit and explain actually what the semiconductor industry looks like. And there are parts to this. And we start at the bottom here. You've got basically chip IP, so intellectual property, right? And companies like ARM sell that intellectual properties to, say, a company like, is Apple on here? I don't know if it is. Yeah, it is. To somebody like Apple, and they can use that to make chips or have someone else make chips for them, right? And then you've got here the Synopsys and Cadence guys, which is what is it called? EDA, Electronic Design Automation Tools. And that's a very unique little subsector. 3 US companies basically dominate that space within the design and complex structuring of semiconductors. Stuff that has to do more than A and B. That's a little bit more complicated. And then you've got the whole subsector of suppliers, in a sense, that builds wafers like Shin-Etsu and SK and the guys who supply parts and chemicals to it. We actually used to supply some of these. I had another business, an alcohol business, and you need ethanol in manufacturing of this. And then you've got the next level up, which gets a little bit more interesting, which is wafer. The wafer are the thin little things that are teeny tiny nanometers thin, right? That chips are sort of based on. These are the wafer equipment fabs. And I'm cheating slightly by looking to my right. I just want to make sure I get this right. Yes, exactly. So this is just essentially the process before making the real chips, right? And that's where the alcohol gets into it, for example. And then the stuff that you and I are more interested in are these 2 parts here. So the right part here, can you get a slightly thicker pen? Microsoft says no. And Microsoft's become a French man. These guys actually make their own chips. They also design them. They kind of do everything. This is your Micron, your Intel, your Samsung, and they do everything. On the left side, you have companies who do design, but they don't manufacture. They let the guys at the top do the manufacturing. So TSMC and companies like Samsung and SMIC, they sit at the top of the pyramid in a way, and they make all the real hardware for your AMDs and your ARMs and your IBMs and Apples and NVIDIAs and so on. So these guys over here, Taiwan Semiconductor, who are their customers? Their largest customer is Apple, and their second largest customer is NVIDIA. And I wouldn't be surprised if NVIDIA doesn't overtake Apple on that front. So let's look at the business. Cash flow is glorious. It's growing very nicely. It's getting too expensive, but profit health is extraordinary. And actually, it isn't that expensive. Do you think it's because it's got Taiwan in the name or something? I don't really know. Maybe it's just not the sexy part of the business. But look at the margins. 54% profit margin for manufacturer. That's pretty extraordinary. And something like a 40% real profit margin is also extraordinary. Return on invested capital at 20%, extraordinary, and profit growth 11%, pretty good. So I would have thought, hang on. I think NVIDIA is going to take all the profit margin. They're going to squeeze these guys really hard. Their margins are going to be terrible. Well, they're not, are they? Their margins are actually pretty exciting. And look at that 70 billion revenue, 9 billion free cash flow in the last 12 months. It was 17 billion the year before, so I presume they're investing a lot in growth, which is actually a good sign. 8 billion more investment, that will probably yield quite a lot. What's the return on invested capital? It's almost 20%. So you should get an extra 2 billion profit per year on that investment. My sort of rule of thumb maths. works out. And they've been very good management, clearly. The earnings per share are just a beat again and again and again and again. So management seems to be, they know what they're doing. And it's not massively expensive. 23 times PE. It's not that much, honestly. I mean, considering everything else we looked at, it's probably the cheapest stock on the list, right? So there we are. Let me know what your favorite stock is out of these. And do yourself a favor and join me and see how we make money in 2 or 3 hours a week, how our trading system actually works. I'll teach it to you for free, felixfrenzel.org/webinar. And of course, make sure you get your pause on that AI benchmark that I made for you at felixfrenzel.org/AI. If you enjoyed the video, abuse and fiddle with the buttons. And I look forward to seeing you on the next one. Thanks.